paid directly by plan funds, then they don't have a investment ERISA bond exposure. On the other side, if they're working with individuals within the company in non-ERISA, say other types of investments, you certainly want them to have an employee dishonesty policy to prevent them stealing non-401k funds. And that policy generally works as a blanket, but it's not specific to your company. If they have a $2 million employee dishonesty policy, then it'll pay up to $2 million for anyone that has loss, as opposed to the investment ERISA bond, which will pay 10% directly to you for plan losses. Now, when we're really talking about, again, why insurance is important to the plan sponsor, we want the plan to make sure that in the event of a loss, either through an error in omission or a theft, that they to be indemnified. ERISA does not mandate fiduciary insurance, so you're not required to have it. On the flip side, ERISA also has said, and the DOL has said, the fact that you didn't buy fiduciary insurance could be a breach of fiduciary duties, because you could have had a policy to protect you, protect the plan, it didn't. Also, the ERISA and DOL says that as a fiduciary, first party, the plan sponsor, or trustee, or plan committee, they're required to make sure that any third-party investment advisors, whether it be the direct advisor or a TPA, be bonded if there's any discretion. So you have a further obligation to make sure that you actually make sure that they're bonded. And you need evidence of that bond, and you have to collect it in your information on a yearly basis. Now, unlike the E&O policy that we really need to read and understand all of the policy language's endorsement, the investment ERISA bonds tend to be fairly similar. The requirement is that, again, up to 10% of plan assets and the limits. They have to be from a recognized carrier from the DOL. So generally speaking, a certificate of insurance on that is acceptable, as opposed to having to specifically either add by